Hi, this is Al Brooks. Thank you for watching the Brooks Trading Course. I gave a talk at the Chicago Mercantile Exchange, and I decided that I'm going to go ahead and record it and make it available to you. I divided the talk into two separate PowerPoints because it was too long as one PowerPoint. This first PowerPoint is on advanced big bar techniques. What I'm talking about are surprise bars. Whenever you see a big bar, something has happened that is telling you that the price is probably wrong. A big bar can be a breakout, it can be a reversal, it can be a measuring gap, and it can be an exhaustion bar, or it can simply be a pause, a give up in a trend causing a two-legged pullback. A big bar tells you that the price needs to change. The price is probably wrong. Most of the time when the market's in a trend, you know the market is going one way, either up or down, but you do not get a lot of information about possible transitions. Sometimes you'll get an unexpected bar. It can either be in the direction of the trend or in the opposite direction. A big bar means that something is different, and that is a low probability event. The probability is that the trend will continue, but now you're getting a surprise bar, a surprisingly big bar. The market needs to move to a new price, or at least it has to check if the new direction will lead to a move or if it's simply a trap. For example, here we have a big bear bar in a bull trend, and it's an unexpected bar. The market's rallying, and now we're getting a big bear bar. The odds are we're going to get at least a small second leg down. Sometimes you'll get a big leg down, but at a minimum, you're expecting that the first reversal back up will not get very far and will get at least a small second leg down. Here we have another surprise, a pair of big bear bars occurring in a bull trend. And instead of a small second leg down, we're getting a bear breakout. This close is below the low of the past 20 bars or so, and it's below the low of the day. The market is probably going at least a little bit lower. Whenever I see something like that, and I'm confident that the market is going lower, I'm looking for a measured move. The first measured move target that I look for is one based upon the size of the breakout. I look at the first bar of the breakout, and then the final bar of the breakout, and I look for a measured move down. And you can see what happened when it reached that target. The market bounced, and that tells you that a lot of the computers took profits there, and some bull computers had limit orders to buy there, expecting the bear computers to take profits, and that would allow the bull computers to make at least a scalp. Here we have another pair of big bear bars, but this time it's occurring 20 or more bars into the bear trend. Here, maybe about 40 bars into the bear trend. Whenever you have the biggest pair of bear bars occurring 20 or more bars into the trend, the odds are it's more likely an exhaustive move, the end of the trend, rather than a measuring gap. Here, big bear bars early in the trend probably leads to a measured move down. This is occurring at least 20 bars into the trend, and it's the biggest bear breakout in the past 20 bars. It's more likely an exhaustive end of the trend. 60% of the time, you get at least a small second leg down, and that's what this little bear bar is, a small second leg down. But 60% of the time, it's going to be the exhaustive end of the trend, and the market will either enter a trading range or reverse into a bull trend. We got a strong reversal up, a bull breakout. I'm going to look for a measured move up based upon the open of the first body and the close of the final body of the bull reversal. And you can see what happened when it got to the target. Bulls took profits and bears sold for a scalp. We have a bear trend here, and then we suddenly have a big bull bar. It's a surprisingly big bull bar, and whenever there's a surprise, you expect at least a small second leg up. This is a very tight bear channel, and therefore a strong reversal up is probably still a minor reversal. and that means that a trading range is more likely than a bull trend. You're expecting at least a small second leg up. It might be this, it might be that. You don't know. It may be a third leg up, but at a minimum, when you see this bar, traders will look to buy, expecting at least a small second leg up. Pretty strong bull trend, small pullback bull trend. And then we got a surprisingly big bear bar. Therefore, the bulls, as this bar was forming, were giving up. When that happens, the bulls who did not exit are confident now the market is going to have at least a small second leg down. They'll use any rally to sell. So you'll have bulls looking to sell. The bears are confident that this is a strong enough bar for at least a small second leg down, and they'll look for any rally to sell as well. So after a surprisingly big bar like this, both the bulls and the bears will sell a rally, expecting at least a small second leg down. You can see that when you have a reversal down, it often pauses at the bottom of the most recent buy climax, which it did right here. Sometimes it goes a little bit below, but it usually gets to that buy climax low. And you can see we have a sell climax, and when the bull trend resumed, it tried to get up to the sell climax high. It got there several times, and eventually the bears gave up. We have a bull channel here, and we're suddenly getting a big bull breakout above a bull channel. That should not happen. When you get the biggest bull breakout late in the bull trend, it's probably going to be an exhaustive end of the trend, although you typically get at least a small second leg up. It could be here, it could be here. A bull breakout of a bull channel, 75% of the time it's going to fail, and instead of leading to a bull trend, it'll convert into a trading range. First target is always the bottom of the most recent buy climax, which is this low. Big bear bar, surprise bear bar. The bulls are giving up. You expect at least a small second leg down. Traders will sell the close. They'll sell below bear bars here or here. We're failing repeatedly at the top of the sell climax bar. Traders will continue to sell below bear bars, below that, below this, below that. I have two different bull trends. Bull trend here, but there's an important difference between the two. This bull trend is in a bull channel, and here we have the biggest breakout late in a bull trend. 70% chance we're going to get a swing down at least to the bottom of the buy climax, this low or this low. You sell a reversal down below a strong bear bar. Here we have a bull bar, a pause, and then a small second leg up, and then a bear bar closing on its low. We should get to the bottom of the channel and the bottom of the buy climax. There's a gap between the close of this bar and this high, the close of this bar and that high, and the close of this bar and the open of the first bar of the buy climax. All of those gaps are magnets. This is the lowest one, and you'd expect the market to test that low and close the gap between this close and that open. Again, we have a bull channel and we have a bull breakout. But what's different is this bull channel is up. This bull channel is sideways, a trading range. When you get a bull breakout above a bull channel, you expect it to fail. When you get a bull breakout above a trading range in a bull trend, it's probably going to lead to a measured move up, at least based upon the height of the trading range. Traders will buy above that bull bar, and the next bar is not a bear body. They'll buy the close of that bar or above the high of this pause bar, expecting at least some kind of a measured move up and possibly a resumption of the bull trend. So bull trend, trading range, breakout, and resumption of the bull trend. The opposite's true in a bear trend. We have a bear trend, we have a bear trend. We have a bear breakout, we have a bear breakout. The difference between the two is this is a bear channel and a breakout. This is a trading range in a bear trend. I don't have the bars to the left, but it was a bear trend trading range and a bear breakout. You'd expect a measured move down. Here, you'd expect a failed bear breakout and an exhaustion. Biggest pair of bear bars occurring more than 20 bars into the bear trend, probably an exhaustion move. There's a gap between the close of the final bar and the open of the first bar. That gap will probably close, and that usually corresponds to around the top of the final sell climax. This is the final sell climax. The market should close the gap and get to the open. This open is also at the high of the bar, and the high of the sell climax is also a target. You buy a reversal up, buy above the bull bar. Here there was no second leg down. You can argue that this little bear bar is a small second leg down. Some computers will see it as a small second leg down. Bear trend, trading range, and then we have a breakout. And follow through, small bear doji, but follow through, odds are we're going lower. Minimum target and measured move may be based upon the height of the trading range. And you can see there was some buying here. Bulls bought expecting the bears to take profits, and the bears took partial profits. The channel here is very tight. We're probably still going lower. This started out as a bear leg in a trading range, but it actually was a resumption of the bear trend, and this breakout was confirmation. This is where the bulls gave up, and the bears won. The bears were able to resume the bear trend. The bulls were hoping for a continuation of the trading range. Traders will sell below the bear breakout bar. They'll sell the bear close. They'll sell bear closes. They'll sell above bear bars. They'll sell below a pullback, expecting lower prices. Take a look at what's going on here. Look at the open of this bar and the close of that bar. There's a gap. Open of this bar is above that close, a gap. We have 4 gap bars, 4 bars where the open of the bar is above the close of the prior bar in a bear trend. That is very aggressive buying. As soon as the bar closes, everyone was placing orders to buy at the market. And there were so many buy orders at the close of this bar that the market had to open above that close. If you see a reversal and you're starting to get 1 or 2 gap bars, gap open bars, that's strong buying. The market's probably going higher. We have an exceptionally big bull bar, an exceptionally big surprise bar. It's a low probability event. Chances are there'll be at least a small second leg up. We have a bear inside bar closing on its low, and that's not good follow through. A lot of bears will view this as a second leg trap. First leg up is this weak rally, and then the second leg up was a very big bull bar. Okay to sell below this bar, taking a chance that we're getting a swing down. But when a bar is so unusually big, chances are there'll be buyers around 50% down. And here we got 1 leg down, and then a bull bar, a pause, and then a second attempt to reverse up. Bulls will buy above this bull bar or above that bull bar, looking for at least a test of this high and possibly a measured move up. Measured move based upon the height of the bar, the open of the first bar to the close of the final bar. Here it's simply 1 bar, and there's the measured move projection. So bulls will buy that close, they'll buy the reversal up, looking for a measured move up. It's reasonable to sell, second leg trap, maybe first leg up, pause, maybe first leg up, pause, and then second leg. However, this close is far above all of the bars to the left. I don't show the bars from yesterday, but this close is far above everything to the left. The bigger the bar, the more it closes on its high, the more likely you're going to get a swing up. Whenever the bar is especially big like this, a lot of bulls don't want to buy up here because the stop is here or here. They don't want to risk that much. And therefore, you often get a pullback to around 50%. You'll have bulls who have limit orders to buy 50%. Other bulls will buy on a reversal up from a 50% pullback, especially when there's a microdouble bottom. We went down and up and down and up. We have a bear trend and a rally with 3 pushes up, 1 pullback, 2 pullback, 3. Does not matter that the pullback from the first push up went to a new low. That's very common when the market transitions from a bear trend to a bull trend. It's very common for the bull trend to begin before the bear trend ends. We also have moving average gap bars. There's a gap between the low of this bar and the moving average, and that's true for all 3 of these bars. Late in a bear trend, usually you get a resumption of the bear trend, and the bears tried here. But then we had a surprisingly big pair of bull bars, 3 bull bars. We're getting a bull breakout above a bear flag, and that should not happen, especially with big bull bars. This is a low probability event. We're probably going at least a little bit higher. Traders will buy closes, and they'll buy with the stop above the bull bars. Get filled right here. Here, we're getting a bear breakout below a trading range. Trading range is in a bear trend. So a bear trend, trading range. And it looks like we're trying to get trend resumption down. The open of this bar is below the close of that bar. There's a gap. Here's another gap down. 2 gaps down early in a bear trend. We're probably going lower. We have a gap here that stayed open. That rarely happens in the E-mini. And it usually closes either the same day or the next day. However, it's still a gap open bar, open below the close of the prior bar, and a sign of very strong selling. We're probably going lower, especially when you get 2 or 3 of them like this. First one, second one. We're in a bull trend. We have a small wedge rally, and then we have a surprisingly big bear bar. A surprise bar, low probability event. Probably we'll get at least a small second leg down. Here we got a swing down. One unusually very big bear bar like this is enough to make the market always in short. If you have to be in the market, if that's your style of trading, if you always want to be in the market all the time, if you were long, you have to get short with this bar. %70 chance of at least a measured move down based upon the height of the bear breakout. It's a 1 bear breakout. Open of the first bar, close of the final bar. It's only 1 bar. You'd expect at least a measured move down based upon the height of that body. We have a very strong bull trend on the open. A pair of bull bars, pause, a pair of bull bars, pause, another bull bar. This is a tight bull channel with 3 legs up. It's a parabolic wedge top, and therefore a possible high of the day. Not a good sell here, but now we have a breakout above the wedge and a bear bar. Some traders will sell below that bear bar or take the second entry short on double top and sell below this bar or that bar. It's still a bull flag, and the market at this point is more likely to go higher. Here we have 15 or 20 bars. It's still a pullback to the moving average in a bull trend. It's still more likely that will go up than it is that will go down. But every bar that gets added increases the probability for the bears. Once you get a pair of bear bars or 3 or 4 bear bars, the market is probably reversing down. We're getting an endless pullback, an endless bull flag, and then a bear breakout below the bull flag. This is a common occurrence after a parabolic wedge rally. Endless pullback, becoming less bullish, more bearish. And then you get a bear breakout. It's a surprise. You do not expect a bear breakout below a bull flag, and therefore you'd expect follow-through selling. Whenever there's a surprise, you got to expect at least a second leg down, and usually some kind of a measured move. And here we got a bear trend. We got more than a measured move based upon the height of the bear flag. We broke to a new low of the day. Here's another possible measuring gap. And we fell for a measured move down based upon the height of the entire rally. Sometimes it's easier to see what's going on if you look at a higher time frame chart. This is an endless pullback. And if you were looking at a 15-minute chart, you'd see this. You'd see a 5-bar bear microchannel with the bar closing at its low. Traders would sell below that bear bar, which is right here, or they'd wait for the breakout and then sell. That would be in here. I think this chart is particularly interesting. This is a weekly chart of the E-mini. Look at this. The biggest pair of bull bars late in a bull trend. You get a pause and then another big bull trend bar. This took place in January. And I wrote on the Books Trading Course website and on the investing.com website and on the Money Show website in January when we were up here saying that the top is probably in, or that it probably would come in within the next couple of weeks and that the market would probably undo the buy climax. It looks like we touched the moving average here. We did not. We were above the moving average for 65 weeks, so it was likely that we were going to at least get down to the moving average. Also, the monthly chart had a 15-bar bull microchannel. That had never happened in the 100-year history of the stock market, either the S&P or the Dow. 65 bars without a pullback to the moving average never happened in the history of the stock market, 100 years. So you'd expect that we would get a correction down here. You'd expect a pullback on the monthly chart to below last month's low. The daily chart had never gone this long without a 5% correction, and therefore you'd expect at least a 5% correction. We ended up getting a 10% correction. However, back in January, in here, I kept saying we're probably going to get at least a 5% correction within the next few weeks because of consecutive buy climaxes on the weekly chart. Strong bull breakout here, so 60% chance of at least one more leg up. But the leg up is usually just 1 or 2 bars, and then you get the correction down to the bottom of the buy climax. And in this particular case, bull breakout here, so 60% chance of at least one more leg up. But the leg up is usually just 1 or 2 bars, and then you get the correction down to the bottom of the buy climax. And in this particular case, the correction was probably going to be all the way down to the moving average because the market had never been 65 bars without touching the moving average. Second consecutive buy climax, a blow off top, should test the bottom of the buy climax here or this low and get at least a couple legs sideways to down. This is the euro versus the dollar 120-minute chart. We have the biggest bear bar occurring more than 20 bars into a bear trend. 60% chance it's an exhaustive end of the trend, but 60% chance we get one more leg down before we get the reversal. Big bear bar, more likely an exhaustive end of the trend than a measuring gap and a new swing down. This is that sell climax. We have a little sell climax here. Turned out we got one more small leg down, but after this, 60% chance, one more leg down and then a reversal up. This is the E-mini. I want to make an important point. We're in a bull trend. We have a surprisingly big bear breakout below potentially a bull flag. Traders are expecting a measured move down and 2 legs down. However, this low is above that low. It's a new low of the day, but above that low. It's possible that this is simply a second leg trap. You have a first leg down here or here, and then a very strong bear breakout. The bear is hoping for a measured move down. Instead, we got a big bull bar closing on its high. The bears who sold will buy back the shorts above the bull bar, and the bulls will buy above that bull bar as well, betting on a failed breakout, betting that this is simply trapping bears into hoping they're going to get a bear trend. But instead, it's simply the second leg down in a trading range. So first leg down, pull back, and then a collapse that's trapping bears into hoping that there'll be a successful bear breakout. Look to the left. We're still above this low, and therefore this sell-off is still in a big trading range and in a bull channel. And therefore, whenever you see a strong sell-off that is in a bull channel or a trading range, you got to be thinking that it might be a bear trap, second leg trap, and it'll fail, and the bull trend will resume. Strong bull reversal, two legs down, and it was a bear trap. Very strong rally. The bulls who bought this close never had a chance to get out. Usually if you do something reasonable, and buying that close after 6, 7, 8 bull bars, it's reasonable. If you put a stop down below the buy climax and buy more above a bull bar in the pullback, you're usually able to avoid a loss. 80% chance you can avoid a loss. So you buy that close, you buy more above this bar, 80% chance we're coming back to that close, and that would allow you to get out break even on that first buy and get a profit on your second buy. Well, look what happened when we got back to this close. Instead of traders selling, bulls selling out of their longs, they bought more. That's a surprise to see this, so we're probably going higher. Here we have 14 bars without a pullback. So 14 bars where every low is at or above the low of the prior bar. That is unusual. However, it's unsustainable, and therefore it's a buy climax. Very strong bull trend, but unsustainable. 14 bars without a pullback, we should get a pullback. Typically, you get a minor reversal, trading range, or bull flag. Here, you had buy the close bulls here. Bulls who bought this close, disappointed by this. When the market got back to that close, they sold. You can see what happened when it got back to that close, they sold. That tells you that the bulls are probably going to give up, which they did here and here. If you look at this on a 60-minute chart, this blue box is this. It's the biggest bull bar late in a bull trend. And on the 60-minute chart, this is probably an exhaustive end of the trend. And you'd expect a pullback down to the bottom of the buy climax. And the bottom of the 60-minute buy climax is down here. We eventually got there on the 5-minute chart. Very strong bull trend, but too strong. A series of buy climaxes, buy climax, pause, buy climax, pause, buy climax. Extreme buy climax. It's also a wedge rally. Typically on the 5-minute chart, you would not expect it to come all the way back down here. But if you knew that the 60-minute chart was at the top of a rally that lasted 20 or 30 bars, and it was the biggest bull bar late in the trend, then you would expect it to come back down here, which is all the way down here. Disappointed bulls exited. Micro double top, we have a bear inside bar, not closing on its low, but closing below the midpoint. Some bears sold below that bear bar, other bears would sell below here, looking for a test all the way down to the bottom of the buy climax. Here we have a very strong rally. We have 8 consecutive bull bars closing on their highs. It's reasonable to buy at the market, buy at the market, buy above the prior bar, buy the close. Let's say you bought this close. The odds of this becoming a bear trend are small. 80% chance that if you buy that close and you buy more above a bull bar, either here, 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 or here, you're going to avoid a loss and you'll probably make a profit. It should get back up to that close. Bulls buy that close, they buy more above a bull bar here or here. When it gets back here, they can get out break even on their first buy and with a profit on their lower buy. Whenever you do something reasonable, and if you manage your trade correctly, which usually means using the appropriate stop here or here and scaling in lower, you're going to make money. When you take a reasonable trade and you manage it correctly, 80% chance of either a profit or no loss. Reasonably strong bear trend, so bears are selling at the market, they're selling below bars, they're selling closes. If you sold this close and you saw this bull bar, you'd be disappointed by that big bull bar. A lot of traders will place a limit order to get out break even. Some of them will scale in higher and then get out break even. And you can see what happened when it got down to this close. Tail, tail, tail. There's buying taking place at this close. Some of it is from bears buying back their shorts, giving up, trying to get out break even. And some of it's also from bulls buying, betting that the bears will get out. They see tails below bars, they see a pretty good bull bar, especially after this tail and that tail. Everybody sees that traders are buying at that close, and that will make bulls buy as well. And then the final bears who did not take the chance to get out break even gave up here and gave up here as well. The bears who sold that close were disappointed by this big bull bar, and they were afraid that they might have sold the low close of the trend. Because of that, they bought back their shorts and they stopped selling. The bulls took over for the next 20 or 30 bars. When you see an especially big disappointment bar, you know that a trading range, or possibly even a bull trend, is now more likely than a resumption of the bear trend. Usually you get one more attempt down when you have a sell to close bear trend, but if you see a lot of buying taking place at that low close, then we're probably going more sideways or possibly up. Traders will look to buy. Take a look at this. We have another very strong bear trend. And let's say you're a bear and you sold closes either here or here, and you're disappointed by this or that. And let's say you get out above a bull bar, above this bull bar, or above that bull bar. It's still always in short. And if you're trying to stay in the market all the time, you have to sell again below a bear bar. You could sell below that bear bar or below this bear bar to get back into the market. The market's in a trading range here, and it's about half the height of an average day's range. Traders are expecting a breakout and either a measured move down or a measured move up. Sometimes before the breakout takes place, the market will start to give you a sign as to what the direction of the breakout will be. Here we have 4 bull bars, 5 bull bars, and that is a sign of buying pressure. Although the bulls are not doing much in terms of price, they are doing a lot in terms of time. A chart is made of time and price, and sometimes a trend can begin with time rather than price. Here, we got 5 bars without the bears having a bear body, and we have 7 bars out of the past 8 bars with only 1 bear body. The bulls are starting to take control, and traders will start to buy. 9 bar, very tight bull channel. Buying pressure increases the chances of a bull breakout. Bulls will start to buy above bars here. Here we have a breakout closing on its high. They'll buy that close or they'll buy above the high of that bull bar, expecting at least higher prices. We broke below yesterday's low and tried to go up, failed, tried to go up again, micro double bottom. We have 8 consecutive bars without a bear body. So the bulls are starting to own a lot of bars. Even though the bars are not big, some are dojis, it's a lot of buying. The odds are we're going to go higher. And look at this. This is the first 25 bars of the day. And one thing you'll notice is there are only 2 bear bars in the first 25 bars of the day. That is a sign of very strong buying. Some of these bars were bear bars until the final seconds. The bulls got the close of the bar back up to the open. So only twice in 25 bars were the bears able to create bear closes. Very strong buying. Bears are not making money. If you're going to be trading, you have to buy for any reason. Buy at the market, buy above bars, buy closes, buy below bars. Chances are the market's going higher. Here we have 7 bars where every low is at or above the low of the prior bar, a 7-bar bull microchannel. Also, on the way up, there are a lot of gaps, the low of this bar, the high of that bar. The bodies here and the bodies here. The low of this bar, the high of this bar. And then these lows and this high. The market's forming gaps. The pullbacks are only lasting a bar or so. It's a small pullback bull trend, which is the strongest type of bull trend. Traders will buy for any reason, expecting higher prices. We have a bull trend, but down here, it's a trading range. On every bar, on every chart, there are always buyers and sellers above every bar and buyers and sellers below every bar. 50% of the time, the stop order trader wins and the breakout succeeds. And 50% of the time, the limit order trader wins and the breakout fails. So for example, we broke out above here, the stop order traders started to win, but then they lost. Here, the stop order traders won. We got to swing up. The bulls are trying to get a reversal up, and they have a pullback. And this is a high 1 bull flag, a pullback in what the bulls hope is a bull trend, but it's a big bear bar closing on this high, and we're at the top of a trading range. That is not a very good looking buy signal, and therefore there probably are more sellers than buyers above the high of this bear bar. It's a bad bull flag. So the limit order traders will probably win. They'll sell the high of this bar 1 point higher, 2 points higher, expecting the market to trade back below the high of this bar. And the opposite is true down here. We're selling off, but this sell signal bar has a bull body, and we're forming a higher low after a pretty good reversal. It's not a very good bear flag. So bear trend, not very strong. A pullback in a bear trend, so it's a bear flag, but it's a big bull bar, a reasonable bull bar closing near its high. Do you think there'll be more buyers or sellers below the low of this bar? Will traders selling with a stop below this bar make money, or will bulls buying with a limit order at the low of this bar make money? It's a bad bear flag, probably more buyers than sellers below, and will probably go higher. I talked about big bars. I call a big bar a surprise bar. It's a low probability event. It can be a breakout. It can be a reversal. It can be an exhaustive end of the trend. It can be temporarily the bulls giving up in a bull trend, creating a bull flag or a trading range, or the bears giving up in a bear trend. I also talked a little bit about bad bull flags and bad bear flags at the end of my talk.